Good morning, everyone. Thank you for joining us today for Coffee with CalTRUST. As you are probably aware, Coffee with CalTRUST is a webinar we do once or twice a year where we start with a who and what CalTRUST is, and then we'll talk about our funds, what's going on in the markets, and just have an overall discussion familiarizing you with CalTRUST and our team at State Street Investment Management. I highly encourage you to make this interactive. I will make sure the chat box is enabled in just a moment. So please use the chat feature, use the Q&A, and let us know how we can be of most assistance to you. So joining me today, or let me introduce myself. I don't think I did that yet. So I am Laura Levanier Kitson. I am your CalTRUST CEO. As many of you know me, I have been with CalTRUST for 17, 18 years now, and in this role as CEO for 6 or 7 years now. I think 7 years now. So I live and breathe CalTRUST, and I'm really excited to have you here with us today. Joining me today from our team at State Street Investment Management, I have Will Goldthwait. He's our client portfolio manager. Simona Mocuta, who is the chief economist at State Street, and Elliot Hentov, who is the chief macro policy strategist at State Street. So I'm really excited for you to be able to hear from them today. The format for our webinar today will be I'll go through an introduction of who and what CalTRUST is. From there, we will pass it over and let Elliot and Simona talk to us about what is going on in the markets these days. And then we'll bring it back around and talk a little bit about the actual nuts and bolts of the CalTRUST funds to wrap up the conversation. So please, again, make this interactive. We will have this available for you later. So without further ado, I'm going to jump on in. So what is CalTRUST? CalTRUST is a local government investment pool. We are a joint powers authority. We were formed in the early 2000s by 2 county treasurers and a special district treasurer specifically, who are looking for an alternative to LAIF, the local agency investment fund, the state's pool, which I'm sure if you're on this line, you're probably familiar with LAIF. Back in the day, that was really the only liquidity option. And so the treasurers of Solano and Sonoma County and the treasurer of Westlands Water District came together and thought of this idea to create CalTRUST. CalTRUST, as a joint powers authority, is only open to California public agencies, and our investment policy mirrors California Investment Code. As I believe I mentioned, State Street Investment Management manages all the assets in the CalTRUST funds, and we regularly do RFPs for all of our service providers. So State Street has been with us for a few years now and won this business through an extensive RFP process. So I'm not going to bore you with all this fine print. This is really here. So when you get a copy of this presentation deck later, you have it for reference. But this is California Government Code 53601P, which explicitly allows for the use of JPA, local government investment pools, by public agencies. So if you're ever looking to cite that code, this is a section of code that says you are allowed to invest in agencies such as CalTRUST. One important thing to note is you'll need to look at your agency's own investment policy statement, as you may be more restrictive than 53601, and at times you'll have to specifically allow this section of code and allow LGIPs as allowable investments if your code is a little bit more restrictive. And again, this is just some more information on the JPA, so you have this for reference. Government Code 6500 and 6509.7 are the pieces that clarify that LGIP JPAs are authorized for use by California public agencies more explicitly. So I already talked about the history. We won't go back into that some more, except there was one key piece that I think is always fun to share, is that when we were first started in 2003, we launched only internally to our founders of the public agency, and went back in 2004 and pushed for some code changes and got Assembly Bill 969 passed in 2004 to give that explicit grant of authority to use pools. Further, it also specified that you don't have to join the Joint Powers Authority to participate in a Joint Powers Authority local government investment pool. So that is one little key piece there, that you can be a full JPA member, or you can just be a shareholder in the pool without having to go through the process of joining the JPA. So at CalTRUST, these are our key objectives. They have really been our key objectives, I would say, since day one. Number one is transparency, flexibility, ease of use, unlimited transactions. As a public agency, it is really important to us that we operate fully as a public agency. And so we are very transparent with all the information at CalTRUST. Our shareholders are able to access their holdings in real time through our online portal. We update them at least monthly on our public-facing website and always have information available to you. Flexibility, having the multiple fund options, which we'll get into later, give you choices on how you use our funds. We try to make it easy. And then there are no limits on transactions. So you can transact as much or as little as you want with CalTRUST. As I mentioned, we were formed in 2003 with our soft launch with 3 agencies and $25 million to get us off the ground. And in 2026, we exceeded over $6 billion in assets, and we manage money for over 140 California public agencies. So let's talk a little bit about our leadership and our staffing. So we are governed by a board of trustees. Our board of trustees is comprised of all California public agency treasurers and investment officers. This is a really key point for us, that when we are looking at candidates to serve on our board, we really want someone who's a practitioner in the space. So actual treasurers, investment managers, folks who have been on the ground doing the work for investments and understand this world. As I mentioned, it's been 7 years now since I was first hired as the first full-time chief executive officer. Previously, I managed CalTRUST under contract with another agency. And then in 2021, we expanded our independent staffing, and we now have 4 more staff members in addition to myself, and hopefully another one coming on soon. So this is a key point, is that CalTRUST staff is all independent public agency employees. We are not tied to our investment manager or to any of our other contracts or any other profit-making entity. We are actually public agency employees. So we are driven by public service, and almost everyone on our staff actually comes from some type of local government background. This is our board of trustees. I won't bother reading them all to you. You can see them on screen, but John Colville, the treasurer for City of Sacramento, is our president. And I always like to point out that Chuck Lamelli, the treasurer tax collector of Solano County, still serves on our board, and he was one of our founders of CalTRUST. So we are here because he was one of the gentlemen that had this brilliant idea. So please take a look at this. And if you ever have any questions too, you can always reach out directly to our board of trustees as well. They are happy to serve as a resource for you too. I mentioned State Street Investment Management handles all of our investment management needs. And then our other service providers include US Bank as our custodian, and Ultimus Fund Solutions manages all of our transfer agency and fund accounting services. So in working with CalTRUST, you'll likely hear these names come up at times, as they are our service providers. And Brown Armstrong is our audit team. We don't have them listed as on here. So I've mentioned some of these already, the key features of CalTRUST. So we are fully compliant with Government Code 53601. We have multiple fund options. We have no minimum or maximum investment amounts. So that means you can invest as little as you want or as much as you want in any of our funds. We may have conversations with you if you do invest in higher amounts, just to make sure we're clear on your objectives. Nothing binding, of course, but just to make sure we're able to provide you the best service and really understand how you're utilizing our funds. There are no minimum or maximum transaction allowances, so you can transact as often as you would like or as rarely as you would like. There are no additional transaction wire or account maintenance fees. And we're fully transparent with our fees. So the CalTRUST information statement, and towards the back of it, actually has a fee schedule. where you can see the exact fees that go to each of the parties that get paid from the CalTRUST funds, or operating fee, investment management, custody. It's all broken down and the exact tiers that the fee structure is under. So our fees are never variable. It's very clearly outlined in the investment policy or in the information statement. So you always know what our fee structure is. You can have unlimited sub-accounts. And one of the great things is things like today, where we have State Street on the line with us, you have access to investment expertise. So as a CalTRUST shareholder, if you ever want to have an individual conversation with someone at CalTRUST or at our investment management team, we can set that up for you as well. Also, I did just enable the chat. So if you have looked at that feature, it should now be working. Our online portal is available 24/7. And so that is always available to you and has customized access levels for individuals. So you are able to set up who has trading authority, who has view-only access, and really customize how that portal works for you. Our statements do come out the first business day following month end by 3 p.m. And then all our additional reporting is available the 5th business day of the month. So this is just a list from Government Code of who can participate. Basically, if you are a public agency in California, or a federally recognized Indian tribe, or a nonprofit whose membership is confined to public agencies, you are eligible to participate in CalTRUST. I can tell you everyone who signed up for this is eligible to participate in CalTRUST because I looked at that list. This is a breakdown, and I apologize for my typo at the top there. I believe this is actually as of June 1, our assets under management. So we had 5.7 billion in assets under management as of June 1. And this is just a breakdown of the different agency types utilizing our fund. Yeah, I think that was supposed to be 6-1. My apologies. Again, 6-1, this is the breakdown of the assets between our 3 funds. So our liquidity fund, our short-term fund, and our medium-term fund. Also, our liquidity fund is our newest fund. We launched that in 2019, and then in that wonderful COVID environment, really nothing made sense. So its fund really started taking off around 2023. So this is just a very brief overview of the funds. Our liquidity fund is our stable net asset value fund that has same day liquidity. So you can access your cash up to noon on that day. And we actually have 3 cutoff times on any particular business day. So if you get a transaction submitted earlier in the day, your wire will be sent earlier in the day, your investment will be made earlier in the day. So that gives you some flexibility to know if you need the cash earlier in the day, you can get a redemption in earlier, and we're going to process that at 9 o'clock. You get it at, let's say, 8 o'clock versus waiting till that noon cutoff. This fund is S&P rated AAA-M, and like I said, it has a stable net asset value. So this fund is really your liquidity. This is the money you need to be able to access and have the ability to get out same day. Next on our lineup, we have our short-term fund. This is next day liquidity with a 10:30 a.m. cutoff time. This is our first floating net asset value fund. So this has that net asset value fluctuation potentially. This is S&P rated AAF. And with the next day liquidity, it means as long as you get a transaction for redemption or purchase in by 10:30 a.m., it will process the following business day. Our medium-term fund has the same liquidity. So again, by 10:30 a.m., you get a transaction in, it will settle the next business day. It is S&P rated AA-F, and it is another floating net asset value fund. So our short-term fund is really like your 1 to 2 year, right? So assets that are going to sit for a while, but not as long. And then your medium-term fund, you really want to think of that as in terms of a total return fund, where you want those assets to sit and grow longer. We do like to talk to folks who are not as familiar with floating net asset values before you go into a medium-term fund, just to make sure you're fully comfortable with the floating net asset value rate concept and looking at things in terms of total return. So we will come back later in the presentation and talk some more about the specifics of these funds. just a little bit of recap, like I mentioned, our online portals are available 24/7. Our office hours are 7:30 to 4:30. That is when staff is reachable, but I am always available to you. It's really easy to get my cell phone number from me. It's on all my communications, and I'm always available myself if I am needed or if you need to get a hold of someone. And you do not have to join the JP to participate in CalTRUST. The key piece is really just making sure your investment policy allows for LGIP JPAs, and if you have it outlined further, specifically allows for CalTRUST. Getting started is easy. Simple participation agreement forms. Everything, excuse me, everything is set up in 48 hours or less. And within 48 hours, business hours, 2 days, you'll be able to have access to get started with your transactions. So with that, I have talked at you a lot over the last few minutes. I really appreciate everyone listening to me chat at you. If there are any questions, please let me know, pop them in the Q&A or pop them into the chat. And what we'll do now is we will transition over and hear from our team at State Street, and then we can always come back around to this later on in the presentation. So without further ado, I'm going to drink my coffee and pass this conversation over and have Will read us some disclaimer language and kick us off with talking about what is going on in our world today.
Thanks, Laura. Appreciate it. Good to be here. Good morning, everybody. So yeah, so much to talk about. I do have to read a disclaimer, as Laura said, and let you know that the information in this webinar is intended for confidential use of CalTRUST and State Street. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by myself, Simona, and Elliot are our opinions and not that of State Street, and comments do not constitute investment advice or analytical research and should not be relied upon as such. We're recording this on June 22nd at 10 a.m. Pacific time. So let's just jump right into it, Simona. Had a very interesting week last week, entirely centered around Warsh's press conference and the statement and sort of this regime change. I like, there's so many things I could ask you, but I guess I'll just ask for what your first impressions were of that meeting and the press conference that followed.
Well, you know, you're saying that your whole week revolved around the press conference. I was in LATAM last week and I was listening to the press conference in a taxi. So my week, I think, was even more interesting than yours. It was an interesting press conference. And I think, you know, the question is, what does it mean? It clearly means a new chapter for the Fed. I think it sounded to me like a Fed that was more hands-on, more, you know, I mean, obviously, Chair Warsh speaks on behalf of the institution, but he made multiple references about this idea that many people around the table is not just him trying to pull everybody around, but I think there is a willingness inside the Fed to look at what's working and what can be improved. And frankly, I think every institution needs that once in a while. So I'm actually, you know, looking forward to see what comes out of this. The signal was clearly hawkish. I don't think quite as hawkish as the markets took it. But moreover, I think the most important overarching takeaway is that this is a new age, a new chapter, maybe not age, but a new chapter, and we should expect things to be done a little bit differently. And that's not the end of the world. We just need to get used to it.
I agree. And, you know, the 5 task force I thought were fantastic. I think
Yes.
the
Yep.
idea that he walked into the building, into the Eccles building, and basically said, let's review everything, which I put out in my Q&A statement, which I know Laura distributed to this audience. So when you think about, I think I know what your favorite task force is going to be, but I'm going to ask you anyways. Which one sort of percolated to the top for you?
Well, we don't know exactly what will transpire out of these task forces, right? We don't know exactly what they'll come back with. So I think you'd make that judgment and you comment absent that information. But I can tell you which one made me the happiest, and I'll start there. It was really the data one. And
Yeah.
you know very well that for years I've been, kind of complaining here and so sulking in my corner, the economist corner, about the deteriorating data quality. And I think of this as like the foundation of everything that we do as analysts, as investors, and what the Fed does as a policymaker. You need the building block for everything is correct information, accurate information, representative information. And I think we've been falling increasingly short on that metric. So I'm very happy to see that there is one agency that's kind of picking the flag and saying we need to do something here to improve this. Obviously, Chair Walsh mentioned that we don't have ownership over this data. We have a lot of respect for the government agencies that do collect it, but I think somebody does need to be the leader. And it does make sense to me that it would be the central bank. And you know why? Because most of the other statistical agencies, their job ends when the data is released, right? So the product is the job. The Fed actually has to take that and make something of it. Investors do the same, right? But they don't have quite the same responsibility as policymakers. So I think it makes sense because the Fed almost, you can argue, has an added interest here for the information to be timely and accurate and comprehensive because they need to make a decision based on it. The BLS releases the data, but there's no decision that's linked to it. So that's the one that made me most happy to see included. But in terms of policy making, in terms of investor interactions, I think the communication is a huge one. It's probably not something that percolates forever. It's a change. I mean, obviously, we got a drastically shorter statement. I don't think we'll have a press conference every meeting anymore. The idea is to hold a press conference when you have something to say, which to me means not necessarily every meeting. And then the bigger one, probably with the longer term implication, is the inflation framework. Again, we don't know exactly what is this, but it's directly tied to the Fed's mandate. So how you think, how you perhaps define the target, how you tweak it. I mean, nothing imminently, we were told, right? But you want to understand how the Fed will think about the inflation on a going forward basis. Many, many things will derive from there.
Yeah, I think really it's those three together that are so closely tied, right? You have your information on what is going on in the economy. And I also like to remind folks that we really are, the United States is the gold standard as far as that data collection goes. When we look across developed markets, we do a very good job of providing a lot of data that's not so easily available in every market. So we do have to take a moment and just say things aren't so bad. But I totally agree as far as needing to update that data. And then how the Fed communicates that data as far as what they're emphasizing, right? We've all sort of gravitated around core PCE. Is core PCE going to be the new preferred measure of inflation, right? Is non-farm payroll going to be the new preferred measure of employment? The revisions. I mean, the chairman said, payroll numbers are great, but maybe it's not until the second
On the third
revision
draft.
right,
Yes.
third draft, exactly, that those payroll numbers are good. So I love the fact that they're looking at all of that. And then I've got a paper coming out shortly that just talks about this whole idea of transparency. And the clickbait out there is that the Fed is going to be less transparent. But I don't think that that's necessarily going to be the case. I like to see you nodding your head or disagreeing there. Right. What are your thoughts on that?
And I have to say, I loved the whole press conference much more than I thought I would. I felt like he was very natural. He was on point. He had an action plan. And there was this sense of leadership that permeated the whole press conference, at least in my estimation. I really appreciated when he basically said, I it's great when financial markets respond to the data, to the information on the state of the economy. That's how it should be. It's not so great when the primary sort of moving mechanism is the Fed stance itself and communication. So I think what it's not about less communication or less, I mean, less communication, yes, but not necessarily less transparency. It's more of putting the burden back where it belongs and the responsibility back where it belongs with markets to assess in the collective wisdom of markets, what should be done, what is the policy path that makes most sense. So less of this overemphasis on we don't care so much about the data, we care about what the Fed says. That I think is actually a good thing going forward.
Yeah, and I don't want to let too much time go by before we bring Elliot in. And I thought the comment that Chair Warsh made about the markets was a good one. So Elliot, let's bring you in. Looking at the price of oil, looking at the markets, looking at the energy markets here. I mean, we're almost back to our February lows in oil from what I just looked at. Um, you made a comment that I thought was so interesting, and I've shared it with a lot of folks, is there's a difference when the war is over and when the markets think the war is over. It feels like we might be pretty close to the markets thinking the war is over, even though I'm already seeing news headlines this morning that saying negotiations over the weekend didn't go so well.
I think the main takeaway is the peace dividend that we would be getting has been cashed. And we've seen this, by the way, we've seen this reflexivity in markets, in equity markets the last few years during the Liberation Day and aftermath last year and on the trade front. We see markets very much looking through every cycle very quickly. And they've done so the same here as well. So we've basically cashed the peace dividend. Oil, I actually think we were close to the floor on oil for where it will be the coming months, because that's roughly equates to where the supply-demand balance should be going forward, plus a residual risk premium that will remain with us. So I'd be surprised if oil drops a lot in the near term. That said, in a year or two beyond, there's a big range of outcomes possible. Historically, when there's a big oil supply shock, an oil glut follows because obviously it incentivizes production and investment elsewhere. And if you think about it, we're still worried about Strait of Hormuz and future shipping. So the argument for more oil in South America and North America and other parts of the world remains pretty strong. And so there is a possibility of an oil glut, but that's really at earliest the 2027 story.
Okay, so I mean, you know, having an oil glut would be a nice thing for Californians on the line who are particularly sensitive to the cost of filling up their cars and all that goes in with transportation costs, farming costs, et cetera. So you thinking here at maybe a bottom of a near-term range, is there a situation where you can imagine where the strait is ultimately closed again, or do you think we've moved past that and this flow of oil, this flow of energy through the Gulf is going to continue now uninterrupted?
I mean, we're clearly in some form of de-escalation process. We've been there for 2 months. It's now proceeding. That means there will be more oil tomorrow than yesterday. Um, that's basically the path we're heading for probably the remainder of this year. I think what gets hard is to look beyond kind of 4 or 5 months out into the future. That I think becomes difficult because this is not a peace deal. This is one party basically saying, okay, I have other things to do. I'm parking this right now. I have no time for this battle. I'll come back to you. In the meantime, here, do whatever you want. That's not a stable equilibrium. So we have the risks that 4 or 5 months from now things could work differently. For now, oil's normalizing. There'll be more every month. I do not think we're going to get back to pre-war levels at all with the Strait of Hormuz, for a variety of reasons. Um, but for the most part, the global market will be amply supplied for the coming months.
So Simona, then turning back to you, how are you thinking about that? This to sort of the sell-off in energy prices, getting closer to where we were pre-war, and then how that impacts overall economic conditions. Most importantly, I guess, where is the U.S. economy headed? I mean, there's been a lot of talk about the resilience of this U.S. economy, and are we actually at a point of acceleration?
Yeah, I think that's the debate that is yet to be settled. I think that's, I am not from the labor market, from the inflation numbers. So obviously the whole meeting was taken very hawkishly. The market's way more hawkish than the dot plot itself, right? Which by the way, I thought the dot plot was masterful because you're always told that these are all independently submitted and nobody knows what anybody else is doing. And yet we had such a perfect 9-to-9 distribution, such that if the chair wanted to put a dot of his own, he could really have the last word. But it all just so happened to fall so perfectly aligned. I think the real debate is: are we in a reacceleration phase such that monetary tightening will be required? I'm not ready to go there. I think the market has kind of taken that view. I think the FOMC is very divided, and I'm divided as well. I say for the start of the year, my bigger concern was the lingering softness in the labor market. We've got a series of reports that kind of put that worry to the side, and I'm ready to be on the train of stabilization in the labor market. I'm not yet ready to jump on the express to overheating, and so I'm a little more cautious. I don't. I think the Fed has no urgency to do anything for many months, not just for the very near future. So I think that's the debate that remains to be settled with incoming data. I would
Yeah,
say we
so
are still in some kind of a Goldilocks, perhaps with a little more strength embedded in that Goldilocks, but I'm happy to see oil prices come down, and I 100% with Elliot. They probably don't go back to where we were pre-Iran, but we don't need them to go back to where they were pre-Iran for the Fed to be able to just sit pat.
right. It does like the market is obviously pricing in some hikes, but it does feel as though now we're sort of in the opposite situation that we were maybe a year ago, where the market was pricing in cuts and the Fed was holding cuts, Fed was holding
Mhm.
cuts, Fed was holding. And now it seems like hikes, Fed is going to hold, hikes, Fed is going to hold. I mean, the ECB just did a 25 basis point hike, and I was asking Nick Pigeon, who runs our liquidity funds in London, you know, do we think this is more of a ceremonial hike, in other words, and doesn't have other hikes, you know, forthcoming? And he was hesitant on that. He feels as though the ECB might be on a path of hiking more. So I guess I wonder from the Fed, is your call now that the Fed is on hold for the remainder of this year?
Yeah, that is the official forecast. But in all honesty and with full disclosure, I have to admit that the alternative scenarios have more than their usual lower probability, because I can see a case where you continue to have this kind of payrolls data that we've been having recently, and even with the help of lower oil prices, maybe the Fed is looking and I say it's just a matter of time until you start seeing a reacceleration in wage inflation, which would then justify them doing something on the hiking end. I don't think we are in that scenario, but it's not just a 5-10% probability. It's more like a 20 plus
Mm,
in my mind right now.
yeah, okay. And so then turning back to Elliot, when we think about other geopolitical tensions that could potentially disrupt the growth story, right? It seems like the US has been sort of running on this AI CapEx super cycle, and there's huge investment and money's flowing into all of these different technological enhancements, advancements, and we will have an AI question before this webinar is over. So those that are
Only
uh,
one.
there, AI always has to be talked about no matter what you do. But Elliot, from a geopolitical standpoint, I guess what I'm hearing is the US-Iran negotiations are sort of going to bump along here. Are there other things from a geopolitical standpoint that you are worried about from a total economic disruption, from a political turmoil, that sort of thing that listeners should sort of keep an ear to?
Yeah, well, first of all, Will, you may be familiar with our geopolitical framework and how we think about it for investing. The one main message I want everybody to take away with is that we are in an era of repeated disruptions. The frequency of disruptions to supply is part of our everyday life now. And that's, whether it's oil shocks or sanctions or trade wars, you're getting constant, repeated, almost annual, little, sometimes big shocks. So that's part of the investment landscape. You ask near term, the risk I'm looking at that people are not talking about much, and it's hard to quantify, but one we should be very serious about is Russia right now. Why? Because Russia's losing. Russia's losing the war, and that means you have, again, a very difficult situation for a kind of a hold-up solitary leader who may experiment with ways to kind of turn the tide of the war. And that experimentation, and I know this is a lot of little sub news that gets lost, is we've had civilian houses in Romania hit by Russian drones. We've had targets hit in the Baltics. We've had a British ship threatened by a Russian cruiser. We've had we had airspace and airports shut in continental Europe. The Russians are testing what can be done, and I'm just worried about this experimentation. It's not going to last long, but I think for the next 6 to 9 months or so, there's quite a risk in Russia that you could basically have an accident happen where some sabotage goes badly, or you get an escalation, and that would obviously be relevant for markets too.
Yeah, that is a definite concern, and I think your comment about Putin being sort of backed into a corner here is particularly tricky. That's certainly a leader that is holding on to his power and not going to let that go at all, and seems to be sort of stuck on this hill. So that's very interesting. So then, Simona, when you think about that, and war is war, it's very hard to put that into your forecasts. But when you think about that potential escalation or potential mistake, how should folks on this call be thinking about that as far as the overall U.S. economy? Is that something that they need to think about right now, or is that something that they can sort of keep an ear out for, but not necessarily be laying awake at night?
Yeah, I think probably for a situation like that or a development event like that, you would have, the market impact be more visible and immediate than the macro impact, right? The economy, unless it's something truly dramatic, is going to look and say, yeah, okay, that too, right? Like in the vein of the resilience we've seen over the last few years in the markets themselves, there could be a response. It can be reversed very quickly, right? But that shock element will manifest there first. So, there are things I worry about in regards to the economy, but not necessarily Putin per se.
Yeah. Okay. That's good. Okay, so now I just want to sort of get back to like a question around the data itself, because I think this is something that listeners on this call should be focused on. So if we're thinking about the data and this whole task force on data analytics, do you think there's any substantial changes that are going to go on there as far as measuring the economy and sort of understanding how we're doing, or do you think it's just going to be at the margin? And one thing that I think about is this whole idea of an inflation trimmed mean. And there's been some talk about that. And could we glide ourselves down to that 2% if we sort of played with the numbers a little bit? Or how are you thinking about that from an economic measurement standpoint?
So from what I took from the press conference was that the interest really is to ensure that the data sets the Fed is looking at are more timely, more comprehensive, more accurate than what we currently have. I did not get the sense at all that the intent is to pick the best one that allows us to declare victory. I think really there is interest on, the economy has transformed dramatically over the last few decades, and yet our data collection processes are still very much the same. So I do think that the primary interest is accuracy, comprehensiveness, action. You want data that's actionable. And I love the term he used that one, and I think more than once, when he said, you want forward-looking guidance, not, echoes of the past. The data should be as up to date as possible. I would love that, right? Because, even on the dot plot, whatever we got was before the deal is settled, right? So things can become obsolete very quickly, which is why you want to take the pulse of the economy up to the minute. So I don't think it's an intentionality to make it easy to say we did what we promised to do. It's really, I do trust that this is a genuine interest in improving the whole ecosystem of macro data.
Yeah. So then when the Fed is going to be communicating, do you I just keep
When
thinking yeah,
the fewer occasions, perhaps, right?
right. And the tighter messages. I mean, I remember years ago, everyone hung on Alan Greenspan's every single word, and people were so focused on it, and they used to go to lunches where he would be a speaker and he'd get up and he'd say absolutely nothing about the economy, and he would actually talk about what he was there to talk about, which had nothing to do with the economy, and everyone would just leave the room exasperated. But at the same time, it was just that's the way things were. Do you think we get a Fed that is just less communicative, or do you think they're just a little tighter in how they're communicating?
I guess truly it remains to be seen, right? Because the chair himself may have his ideas and inclinations, but this is a whole committee with people with their own inclinations. I do suspect that maybe they'll be emphasizing more the framework of thought about the economy and less emphasis on, expect us to do X, Y, and Z, or expect us to not do anything, right? But more, this is how we are thinking about it, and make of it
Yeah.
what you will.
Yeah.
Those kind of speeches are really always very helpful and I think, Governor Waller has had a series of them, but that's what you want to understand. What do you care about? And, the point isn't to say, well, this is what we are going to do in 2 weeks' time. I mean, I know the markets love that, but really the value is the thought process underlying their views on the economy.
Yeah. Yeah, super interesting. Okay, so then productivity. The AI, we gotta talk about it. Um, Productivity gains seem to be there. I mean, I can testify to my own productivity gains in using various forms of AI to help me along the way. Um, Productivity in this country is measured sort of in a strange way, is my rudimentary understanding of it, but it sort of falls more in like units of labor and profitability. Do you think he wants to start to look at that differently? And, we are going through very much a technological revolution here that's likened to any of the greatest ones. I'll put it right up there with electricity. I mean, it's really remarkable. Do you think they're going to start to think about it differently, maybe as far as measurement goes, or as far as like how this is truly affecting the economy?
Well, I I don't know if I have a real answer for you there. I think at the end of the day, productivity is in essence some kind of output per unit of input.
Yeah.
So there is only that much that you can change the measurement approach. But what I sensed, it seemed like Chair Walsh also agreed that this is truly transformative technology and capability. But he also talked about we also need to be keep an eye out for some of the downside effects. And in my mind, that's, code word for labor displacement, because the Fed does have a dual mandate of full employment. So what does full employment mean in the age of AI? That was to me the angle that probably they want to investigate, because it's not just to say, well, growth is fine. But what if unemployment rises because of labor displacement? Is your how do you measure your employment mandate in that world? So I think to me it's a more profound conversation and investigation that they are trying to undertake here, and that's exactly what we need because we haven't, I am concerned about labor displacement here, but I don't know over what period of time truly what the extent of it is, but that will change, uh, you know, the sort of numbers that the Fed will get. And
Yeah. Yeah. No, thank you. And Simona, I know we just have a couple minutes with you left, and we will continue talking. But any last any last thoughts or comments that you have, Simona? Like most notable, or sorry, the question I'm most interested in is, things that you think perhaps the market is missing, or things that you think the Fed might miss, things that are sort of top of your mind from perhaps what people are looking past.
Yeah, I mean, to me, again, I come back to this idea. I'm not ready to declare victory on the labor market. I see a lot of contradictions in even the data that we get. Some things that should both move in the same directions are moving in opposite directions. So I need more clarity. But then also in the backdrop, and a reason why we are advocating for patience, and not rush with the hikes is, in April of this year, the personal savings rate was 2.6%. In April of last year was 5.5%. My guess is that it goes even lower. So you have a full employment economy, more or less, and yet you have a component of the consumer, talk about this K-shaped reality that is truly increasingly struggling. So I wonder if the consumer spending strength is not overstated, or like the resilience we've seen so far has come at the cost of the saving, and whether that it's more of a warning sign for the second half of the year, past the World Cup and all of this, seasonal aids that we've been having. So to me, that's the thing that I'm a little, uneasy about, and I want to understand, how big of a vulnerability that truly is.
Yeah, and I mean, I was listening to an interview with someone that was talking about the leverage that's going on in Asia right now as far as new AI wealth, i.e., they
Mm.
own certain equities that are ballooning. They're then using either profit or leverage to live a lifestyle. And it was just so reminiscent of the dot-com bubble for me, when people were borrowing off their margin accounts and just living, like it was 1999. So it was a bit
Luckily, that's
scary.
not the case in the US.
Yeah.
The savings rate is very low, but the debt service ratio for households in the aggregate looks actually very good. So, the overall picture is much more encouraging.
Well, and also that's what has allowed this cycle to extend for as long as it has, right? Is that people did such a good job cleaning up balance sheets, both corporate, municipal, personal, from 2008, that they are in very good shape and very resilient.
Yep.
But Elliot, there's a question that came in, and it's great because this anonymous attendee was reading my mind because I wanted to go there. China. There's so much talk about China and what is going on with them. They're exporting their excess capacity to the world. It's causing deflation. It's causing massive disruption. One of the hot stories has been around Germany now being at risk with their highly technical manufacturing sector now being overwhelmed by German. How are you thinking about China these days as far as friend, foe, tariffs, no tariffs, when you think about them on the world stage?
Yeah, it's a good question. It's the right one to ask. The reality is the problem with observing China policy is that it's not transparent. It's basically where Warsh wants to take the Fed many years advanced. I'm joking here, but it communicates at will, but it does not reveal its hand. So you have to triangulate what is actually happening. So one very important piece of data that we do now have is the Chinese were able to throttle their oil consumption significantly during the Iran war. By doing so, they stabilized global markets, they stabilized the global economy. They also gave runway to the US for a longer diplomatic process. That's behavior suggests that that they are not eager for disruption. They're quite happy with the status quo geopolitically. Remember that last year, just 12 months ago, China basically was able to demonstrate escalation dominance in the trade war and show that it had tools. It was able to exhibit that the US had dependency on China in a way that basically capped the ability of the US to wage economic warfare. And so China's relatively happy with the status quo. The status quo, from their perspective, is they need time is on their side. There's basically the West, led by the US, is ebbing economic, political, financial capital over time. It's slipping away. It's draining its military arsenals. That's all good over time. And at the same time, China is heavily reliant on the global economy to absorb its exports. It has, you mentioned the overcapacity. The two are linked. So kind of, hey, we're geopolitically very cooperative because we're economically still in this warped growth model where we have this overcapacity that we've built up over decades that has to find a place. And if you look at the growth numbers, it's a shame Simona to leave us, but if you look at the growth decomposition in China, the share that is coming from exports remains very high. And as a share of global GDP, I mean, I really want to draw attention to this. China's current account surplus as a share of global activity is perhaps the largest ever, not for China, but for any country. Meaning, so having an export surplus as a share of global GDP in that magnitude is basically unprecedented. So you're going to hit limits, and what the Europeans are now experiencing is China shock 2.0. It's a little bit of they've moved up the value chain. So now you're not just talking about mid-level manufacturing jobs, but you're talking about advanced manufacturing jobs, advanced industries of the future that are now being eroded by Chinese overcapacity. And I just want to outline how that's happening. It's not that Chinese products are flooding European markets, which is going to happen too. But what they've already done is they flooded emerging markets and they've pushed European competitors out of the Chinese market. That's already lowered Europe's performance a lot, particularly Europe's export-oriented companies. Think of German auto. They're selling a third of the amount of cars that they used to be selling in China just a decade ago. And so that damage is already there. We are not even talking yet about Chinese products really flooding the European market. That is coming. It's building. You see it in electric vehicles. You see it in other areas. So long story short, geopolitically cooperative because they need the export markets. But as you point out, that's eventually the rest of the world is going to become more American in its approach to China because it's inevitable. The trade imbalance is just going to be existential.
Yeah. So basically what I heard you just say is China is like the most profitable corporation, and I'm air quoting, on the planet, right? They've been able to sell so much and their current account surplus is just excess. That's unsustainable, right? I think that's what I heard that. So then how does that play out, and does that playing out ultimately have a major impact on developed markets? Does that ultimately hurt the US? I mean, we're already feeling inflation pressures, right, because of tariffs on the import side. Does that further cause challenges in the US, or do these tariffs stop it and then allow the US to like rebuild, whether it's a manufacturing sector or somehow just be in better control of the economic destiny, so to speak?
So the problem is the timeline here is very slow. If you recall how long it took from China Shock 1.0 until you got a political response, it was a decade plus from the economic effects taking hold until you basically started to have a policy response. It'll be a bit faster this time around because I think the radar is on. So number one, this takes a lot of time. Number two, in the meantime, there is a benefit of overcapacity. It's basically subsidy. So you're subsidizing something. What are you subsidizing? Whatever you're subsidizing is coming at a cost below market price. So that's disinflationary. And China continues to be in certain domains very disinflationary.
Mm.
It's disinflationary in parts of the renewable sector, in electric vehicles and batteries and so forth. So there is still kind of a positive gain that's coming through to the global economy from China, but again, politically not sustainable. And then the biggest question is, okay, great, you have this huge export surplus. That's on the trade front. What do you get in exchange for exports? You get money. Now, what are you doing with that capital? And the capital flow in reverse that's not that different than it was 10, 15 years ago. It's still flowing, by the way, it's still largely flowing into US dollars.
Yeah.
By the way, they're still buying a lot of US treasuries, not under the name China. They're doing it through intermediaries. So it's showing up in different parts. It's through third-party custodians or through fund vehicles. By the way, nothing nefarious here. It's just, this is a way they're diversifying how the money's managed. But they're still purchasing US dollar assets in large quantities as well as others. So that flow is still the same. But again, this requires a political kind of switch to unwind. But you're seeing the tensions. By the way, the Europeans just met this weekend, or they had proposed putting trade tariffs on China, raising them, narrowly voted against that. But you can see the pressure in the pot is boiling.
Yeah. Yeah. Okay. Last question for you, Elliot, and then we can go back to Laura. AI. What are your thoughts on AI when you think about it? What's top of mind, first reaction, when I utter the words?
Yeah, well, AI is an investment, so let's think about that. Um, the number one question I've got in 2025 is the AI capex story ultimately a bubble? Yes or no? And my answer is, I think everybody should think back to high school. What was the classic dramas they had to read? It depends on where you went to school, whether it was Shakespeare or Goethe or Greek tragedies, but they all had a very similar structure. It's usually 5 acts. Act one, you introduce the protagonist. That's kind of, hey, ChatGPT shows up. It's an LLM. Look what it can do. The act two, it scales up. It looks really exciting. Great things are happening. In act three, you start to see, ooh, the protagonists are starting to make some dodgy choices that are going to turn out bad. You're reading the play or sitting in the audience, and this is not good. And what am I talking about? That's when, okay, now debt levels are going up. Leverage is creeping up. It used to be for most of the tech company, the average was 40% of operating cash flow went to debt. Now we're at 80%. It peaked at about 100 in the dot-com. You get circularity of money. Hey, my investor is my customer, is also my supplier. Well, that's just money moving around from within the sphere of the balance sheets. And so these are the types of things we see in Act 3. And then Act 4, I'm afraid, is when you see really big hype taking another level. And that's when the IPO wave is happening. That's when a lot of people cash out a lot of the early winnings. So that would suggest, hey, Act 5, we're coming and it's popping. No, that's not the message here yet. There is that risk, and it makes sense to pay attention to that because, again, we have a lot of signs. But when we did serious analysis in the macro team, our assessment is that if you think about where the money's going, this is not just buying companies who are producing nothing. That was a little bit some of the feature.com kind of an idea that maybe one day was going to do something. Most of the money is actually going into hard infrastructure. So then I still get questions. Well, if it's like infrastructure, wasn't the dot-com bust also infrastructure? We built out all these fiber optic cables, or in the 1850s, we built out railways before they were economical. In those cases, when we looked at the supply was being built before demand was there. That does not seem to be the case today with AI compute and the chips that are required to power all the AI demand. So we have a situation where demand's ahead, supply has not caught up. And so that speaks against the bubble thesis. And people will have read the news, companies like Uber saying, hey, we're limiting token usage. A lot of other companies saying we need to economize. We can't just all be spending all this fortune on AI. That tells us demand's actually ahead of where supply can keep up because it's still too expensive to run. So you'll need to have more supply going. So that makes me much more comfortable. So I do not think it's a bubble. I think we're actually still very much in the mid innings. But two things to watch for is not everybody can be right. So capital is clearly being misallocated. We don't need 10 top-notch AI models. We probably need 2, maybe 3. So some money is being misinvested. That doesn't necessarily be a bubble. And the second one, really, and that's the thing to watch, when do revenues from outside the sector start growing? Meaning, when is it not just money moving around between the chip maker to the data center company to the model, the AI company? When is it actually businesses like the ones you and I work for, enterprises spending a lot of money on AI, and that's starting to really taking up a higher share of revenue in the sector? That's the variable to watch.
I think that's a phenomenal way to put it. And I also see there's two types of friction. One type of friction is that AI will reduce friction to higher profits. But the second friction is the employees that are using that AI aren't necessarily moving as quickly as perhaps the CEO wants them to move. So there's human friction, right? And we all have experienced this when we're trying to use new technology and whatnot. Laura, there's one more question on China, which I'm happy to address quickly before. Is that okay? Okay. Yeah, so it's a good question, but basically the question is this, Elliot, China buying and owning too many US Treasuries, is that dangerous? And in an aggressive move, could China unwind those treasury holdings? And this is a question that we got when China a couple of years ago, maybe it was more than that now, went from approximately 1.1 trillion of US Treasury holdings down to about 800 billion, which is I think where they are now. I haven't checked recently as far as official account. But I guess the question, it's a good question, but I guess the question is, where would they go with that money? And what is the alternative? So Elliot, I don't know if you have any comments on that.
Yeah, we've got this question a lot, and the short answer is this is only really thinkable in conflict in a wartime, when you because all they would get is a very, very short-term temporary destabilization of the treasury market with that move. It would be very short, and you can only fire that bullet once. And as you say, there's a lot of problems with that. First of all, it would make them much poorer. It's their treasuries after all. So they would lose. They would also pay a huge price given their enormous net international investment position, meaning they are a net creditor to the rest of the world. They own a lot of US assets, not only treasuries, everything else that is priced off of treasury. So that destabilization would be very painful across their whole portfolio. So it's only a wartime scenario to really imagine them doing that. I think it's very unlikely. And to your point, they reduce their treasuries on their official book, but if you add up all the indirect holdings that they have cross-border, they've actually kept their treasury holdings pretty flat the past decade. And by the way, the other money has gone into other US dollar assets, equities, corporate bonds, and so forth. So their appetite for US assets, US dollar assets remains very high. Why? Because US capital markets remain the largest ones in the world. And it's very hard to manage a portfolio in the trillions without using US dollar assets.
Yeah, and that was something that, came up when we were in the midst of the tariff scare from a year ago. And people were talking about, oh, capital's leaving the US, capital's leaving the US. Well, that was a lot of speculation, but ultimately never really came to be because people recognize that the US is an excellent place to put your capital to work. So Laura, why don't we pause there and turn it back to you and see if there's anything else you want us to answer, or you can go further on into some of the description around the funds.
Great. Thank you, Elliot. Anybody else has anything for him, please let us know. And then I think, Will, what I'd like to do is in general kind of pass it over to you to talk about how State Street is looking at this functionally in positioning the
Yeah.
CalTRUST fund. So what I'll do while folks are thinking, I'm just going to share briefly what kind of our fund data looks like, and then let you talk about kind of the applicable. We don't have much time left, but we can talk for a few minutes on that, and then we're always available if folks want to have follow-up conversation with us. So I think you should be able to see my screen again. These are our reports from the month of May. So this is just a brief look at where the liquidity fund is, the short term, and the medium term. Again, these are all available on our website and will all be sent out to everyone with a recap of this webinar. But Will, if you could talk just about kind of the practicality now. We're hearing all these amazing things from Simona and from Elliot, and I love your AI analogy, by the way, Elliot. That's the best way I've heard it described. Thank you so much for that. But Will, if you could bring it back a little bit now to like, what does this actually mean for how we're managing the CalTRUST funds?
Absolutely. So I think the way we're thinking about the market right now, to use sort of the statistical reference, fat or tails. So if you think about that bell curve probability distribution, the chance of something occurring at the tails at the furthest ends of that distribution have grown greater. And so from a positioning standpoint, in the short term and the medium term fund, we're thinking much more about getting closer to home. In other words, being more in a duration neutral case and being more in a credit neutral case. Just because the outcomes could vary so much, right? We could end up with a Fed that's going to raise rates. We could end up with a Fed that's going to ease rates. We could end up with sustained inflation pressures or easing inflation pressures, conflict, no conflict. So there's just, because this dispersion has grown wider at the tails, we just feel as it makes sense to get closer to home. And I think, you know, what we've talked about on this webinar is testimony to all of that, right? As just the varies of outcomes, both with the Fed and their task force and thinking about all that. Elliot's description of what's going on with Putin and Russia, as well as China, what's going on there. Middle East is sort of the known. That's going to be very disruptive as we make our way to hopefully a peace process there. So with that, we feel as though pulling the portfolios closer to home makes sense. In the liquidity pool, we're running a little bit longer. If you think about in the context of duration, 1 to 60 days is our allowance. We're running at 48-ish, in the mid to high 40s. The money market curve has really given us an opportunity to keep the duration a little bit longer, but not have to use up a lot of duration. And so what I mean by that is by buying 3 and 4 months instruments, not 1 year. So those 3 and 4 month instruments, they roll down the curve quickly. They provide additional yield to the portfolio, but it doesn't pose a lot of risk for the portfolio. And the names that we're buying in that liquidity fund are rock solid, right? These are the largest GSIFI institutions. And so those are all very, very good names, very solid names. And so with this steeper curve, with the potential that the Fed is going to raise rates according to the market this year, we feel as though that's been a nice trade to add incremental yield to the portfolio. So overall, for the short term, medium term, thinking getting a little bit closer to duration neutral as time goes on, being very cautious on credit, which has been a theme we've been leaning on for quite a while now. And then with the liquidity fund, taking opportunities to buy a little bit of, maybe I'll call it conservative duration right now in only 3-4 month paper, as opposed to, you know, swinging for the fences. Portfolio manager this morning told me that a name issued in 1 year 425 last week, and this morning the paper is 440 bid. So 425 yield, and now it's 440 yield. That's a pretty big move when you come to 1 year money market type paper. So those sorts of things we're being cautious on, just given the volatility that we foresee in the coming months. So a couple things when we think about implications, what are the risks and the catalysts that would change our view? CapEx slowdown, funding and treasury supply pressures. So just this extraordinary amount of treasury funding that needs to go out. Scott Bessent's got a lot of work to do to fund the government. Smaller Fed balance sheet, so we're going to be very tuned to Chair Warsh's task force around the balance sheet. So if the Fed says they're going to shrink their balance sheet, then that can mean some disruption at the front end. And then just this new inflation, if we move into this new inflation paradigm where the Fed just stays higher for longer because they're trying to really knock out inflation and it's not wanting to be knocked out, that is going to have us adjust our views. And then ultimately, lastly, just overall sovereign debt concern. There's a lot of countries that are having to issue a lot of debt. The UK with their new premier coming in, they have a whole budget reconciliation process that they'll need to go through. We're issuing a lot of debt. France has been in the headlines on that. So sovereign debt concerns is another one that we're keeping a close eye on. So those are the things that we're gonna be closely watching in the next quarter or two.
Great, thank you. Well, we are about out time here. So unless either of you have any final thoughts, I'll wrap us up and take us home for the day.
All good.
Great. Well, thank you both so much for joining us. I always learn so much from our webinars. I've got 5 pages of notes here in front of me. And for our audience, to let you know, these are the kind of discussions too that we have amongst our board of trustees. So actually the CalTRUST board of trustees will be meeting this week and have a team from State Street out with us in person to continue these discussions and really talk into the nuts and bolts of how our portfolios are being constructed and managed right now and what's going on in the world. So thank you, Will. Thank you, Elliot. Simona's no longer with us, but thank you to her. She had to jump off for another call. For everyone on the call, thank you so much for joining part of your morning with us. I know everyone's time is so valuable, and I really appreciate you seeing the value and spending some time with us. We will be following up with your coffee and sending out a copy of the deck from today, as well as letting you know when the recording from today is available to access. So if you do have any questions, you can always reach out to me directly. My email is easy, Laura, Laura, @caltrust.org. It'll also be in the deck I send out will be in contact information for myself and Will. Always reach out to our team. I know a lot of you work closely with other members of the CalTRUST team. Are all here available for you as a resource. So please don't be strangers. Let us know how we can help you and what additional questions you might have to follow up with after this. And I hope everyone has a wonderful day. Thank you so much for joining us today.